Hey guys, how's it going? Today's episode is super cool and useful. I just wish I had easy access to this crucial knowledge back in the day. So here's what we've got. First up, the eternal investment strategy, your financial holy grail. Ready to conquer chaos like Buffett? Then part 2, Fed rate cuts? Time to panic or time to profit? Here's the answer. Third, and this one's a wow, one chart, 3 players, Fed rates, S&P 500, and bonds, your treasure map to smart investing. And the grand finale, Buffett's secret to success. It's all about the market's caffeine-like reaction to rate cuts.
Introduction.
Let's start with the left side of the chart. Look at the upper left part of the chart, just left of the first red dot, around the year 2000. What do we see? We see the Fed's interest rate climbing like a teenager trying to prove it's all grown up. This is the late cycle. The rate keeps going up, and up, as if it doesn't know when to stop, and finally, bam, the red dot, halt. Throughout this period of rising rates, the market also keeps puffing its way upward, as if in a race with the rate to see who can go higher. But then, the first rate cut happens. The cycle of rate cuts begins. And just like that, the stock market decides it's time for a little dip. You know, just to remind everyone who's really in charge here, take a look at the second red dot around 2008. Same old story, the rate starts to drop, and the market says, oh, is it that time again? And of course, down it goes. It's like déjà vu. But instead of pleasant memories, it's panic and sell-offs. Classic. Next, let's examine the third red dot. The recent COVID-19 pandemic. Here's where things get a bit different. At first, the market seemed to think, hey, everything's fine, and continued to rise even as rates were cut. But soon enough, it thought, maybe it's time for a correction after all, and down it went. Why did it initially keep climbing? We'll get to that in a bit, so don't go anywhere. Now let's focus on the fourth red dot, the expected start of rate cuts in September 2024. Every analyst and expert is practically praying that Jerome Powell, the Fed chair, will lower the rate. But what's going to happen to the market? Here's where it gets really interesting. Some investors and bloggers are convinced that as soon as the rate cuts begin, the market is going to skyrocket. Maybe it's because of the upcoming US presidential election, or maybe because the market has been on a hot streak lately, even with high rates, and with lower rates. Well, it's bound to shatter all records. But who knows? Maybe the market will surprise us all again. So, buckle up, it's going to be a wild ride. Just for reference, how the Fed rate works and why it's raised. When the economy is boiling like a pot of overcooked pasta, inflation starts rising like it's on steroids. To prevent this economic pasta from spilling over the edges, the Fed decides to turn down the heat by raising the interest rate. And raising the rate works like a cold shower on a hot economy. Loans become more expensive for both businesses and regular folks, which is supposed to cool things down a bit and bring inflation back to a normal, predictable level. But here's what happens next. When the Fed lowers the rate again, the economy starts to recover. Loans become cheaper, and the economy heats up like the latest season of your favorite TV show. Just don't forget that during the rate hike, some negative effects pile up. These include a rise in bankruptcies, unemployment, and the number of jobless claims. And this accumulated negativity, like old car problems you've been ignoring until it's too late, causes corrections in the stock market. So yes, lowering the rate does help the economy get back on track, but the accumulated problems often lead to temporary dips in the stock market, as we've clearly seen on our main chart. Let's get back to the chart. Historically, as soon as the Fed starts lowering rates, the stock market begins to fall. Even in the pandemic year, when the market seemed slow to react to the rate cuts, it still took a dive, just with a bit of a delay. It's like the market took a year to realize that eating that expired sushi wasn't the best idea. So what is this eternal strategy for making money? Let's say your portfolio is heavily invested in the S&P 500, perhaps through the SPY instrument like I do. It's one of the most convenient tools. You buy one stock and boom, you've got 500 companies in your portfolio. Talk about fireworks on a budget. Now here's the trick. You hold on to that S&P 500 until the US Treasury yield curve inverts. And as soon as the Fed starts its turnaround and begins cutting rates, the big players start selling off their stocks and moving money into the bond market, or the money market. This could be 20-year US Treasuries, TLT, TMF, or, like Warren Buffett, short-term Treasury Bonds. Remember how Buffett was selling Apple stock in the first half of 2024? What did he do with the money? He didn't go on a buying spree with new companies. He parked it in liquid instruments like bonds. Why do the big players and institutional investors do this? Why sell stocks when they seem to be climbing? Because if all the big players dumped their stocks in one day, the market would crash faster than a cheap laptop on Black Friday. They start selling early because when the Fed cuts rates, the stock market declines and the bond market, money market, rises. This happened in 2000, 2008 during the pandemic, and even before 2000. This pattern repeats itself over and over again. That's the eternal investment strategy. But remember, sometimes there's a delay, like in the pandemic year, nearly a whole year. By the way, TLT has already started to rise, which proves that market players are shifting their money there. Say goodbye to TLT at $90 because we won't see those prices again anytime soon. Its price is likely to climb in the near future. And here's the kicker. We can almost perfectly time the market bottom. But this is only possible if the Fed drops rates close to zero. When that happens, and the rate-cutting cycle ends, that's the peak for the bond market, money market. That's when you lock in your gains from bonds and shift your money into the stock market. And you hold those stocks until a new rate-cutting cycle starts, which, of course, follows a rate hike cycle. Let's sum it up. As long as rates are either stable or rising, you stay in stocks, chill out, and enjoy the ride. When you see signals that rates will start falling soon, lock in your stock gains, move into bonds, and wait for the end of the rate-cutting cycle. Then jump back into stocks. Of course, you don't have to move all your money at once, but a percentage of your portfolio could be making you money forever. How much to allocate is up to you. And even in the COVID year, when rates were already dropping but the market kept rising, if you were shifting into bonds, you wouldn't have lost much since the bond market was also on the rise. The trickiest part in all this is timing the exit from bonds and shifting back into stocks. We don't know exactly when the rate-cutting cycle will end. There's no guarantee that rates will drop to zero. That might not happen. So, you need to keep an eye on the news and listen to Fed chair speeches to understand their plans for the near future. This perpetual motion machine, and why perpetual? Simply because the money keeps rolling in, even when the stock market is tanking, is called the big rotation. It's a well-studied phenomenon of an endless income source. What we have here are two interconnected vessels, the bond market and the stock market, with liquidity flowing smoothly from one to the other. This is what's known as the risk-on and risk-off modes. When all the money is in the stock market, risk is on. When the money is in the bond market, risk is off. Simple yet brilliant. Is a deep recession necessary for big players' money to flow into the bond market? No, a recession is not required. History shows periods when money shifted to the bond market, bonds skyrocketed, but there was no market crash in the U.S. Why is TLT already rising? It wasn't long ago that it was at $84, and now it's almost $100. Market players aren't stupid. They know and suspect that soon, likely in September 2024, the rate-cutting cycle will begin. This expectation is already priced into TLT. Recently, Warren Buffett said he wakes up every Monday and buys $5 billion worth of U.S. bonds. Notice how small investors still hold stocks, while Buffett has been moving part of his funds into bonds for quite some time. Let me remind you that as of July 2024, Buffett's company had about $300 billion in highly liquid instruments, meaning Treasury bonds. By the way, none of the big players just sits on cash. When you read that Buffett has amassed $300 billion in cash, it's actually a cash equivalent, almost always bonds. Why not just cash? Because it's vulnerable to inflation and your money should always be working for you. Every day. And many large companies like Apple, Amazon, Google, and Tesla also have a pile of cash on their balance sheets. This boosts their overall returns because even if they're just sitting on that cash, with the current high Fed rate, they're earning about 5.5% annual interest on it, which matches the Fed rate.
Will there be another all-time high after the Fed starts cutting rates? All right, folks. Now let's dive into one of the biggest questions floating around. Will there be another all-time high for the S&P 500 after the Fed starts slashing rates? Well, grab your popcorn because the short answer is, it's possible. In fact, we've seen it happen before. 2019, anyone? Remember that? Take a look right here on our chart. You can clearly spot the peak. Yep. Oh, and then bam, the fall we all knew was coming, like trying to balance too many plates at a buffet. But wait, before you get too comfy with that idea, let's talk about the bond market for a second. Because, surprise, it did exactly what it was supposed to do. Bonds, my friends, are like the responsible sibling in the family, always there when things get shaky, but not necessarily throwing wild parties. You might be looking at the bond market and thinking, hey, that doesn't look like a roller coaster of profits to me. And you're not wrong, bonds aren't going to turn you into a billionaire overnight. But hey, let me remind you, for those of you looking for a little more thrill in your investment life, you can always throw part of your capital into something spicier, like Karmov TMF, instead of Farmov TLT. That's like trading your family sedan for a sports car. Still gets you there, but with a lot more adrenaline. Bonds on steroids, TMF versus TLT. So what are we talking about here? Instead of buying the iShares 20-plus year Treasury Bond ETF, DASAS or TLT, you go for the Direction Daily 20-plus year Treasury Bull 3X shares, or SASR TMF. That's right. It's 3 times the fun, 3 times the volatility, and 3 times the potential gains. Yes, the ride might get a bit bumpier, but hey, no risk, no reward, right? But just to be clear here, this is not me telling you to go all in on TMF, okay? This is not financial advice. It's like me saying, hey, some people like to skydive. I'm just pointing out where the nearest parachute is. The market's been doing this dance for decades, and I'm just here to show you the moves. Whether you want a tango or not is up to you. How do I feel about volatility? All right, let's get personal for a second. How do I feel about volatility? Well, let me tell you, I don't really see it as pure risk. Think about it like this. Imagine you inherit a house, a nice one, and you decide to rent it out. It's bringing in, say, $5,000 a month. Now, whether that house goes up or down in value over the course of a month or even a year, does it really matter to you? Not unless you're planning to sell it, right? I mean, come on. You're still collecting that sweet rental income every month, right? You're not out there trying to time the housing market or freaking out about Zillow estimates. You're just chilling, enjoying your cash flow while everyone else is obsessing over the price fluctuations. That's volatility. But if you're not selling, then who cares? It's like getting worked up over the price of bananas when you own an orchard. As a long-term investor, I'm pretty chill with volatility. In fact, let's be real, I kind of love it. It's like my old friend that comes around, shakes things up a little, and then moves on. But here's the catch. You've got to have a long-term mindset. We're talking 7 years minimum, ideally 10 to 15 years or more. If you're in it for the long haul, volatility is just part of the ride. Heck, it might even make the journey more interesting. Why not just buy Chinese stocks instead? All right, let's tackle a question I get a lot. If the US markets are on the verge of a downturn, why not just shift into Chinese stocks? I mean, China's market is already in the dumps, right? Wouldn't it make sense to jump in while it's low and ride the wave up? Hey, fair question. Even the big names like Michael Burry, the guy who basically called the 2008 housing crisis, has been steadily reducing his positions in US stocks and loading up on Chinese ones. So should we all follow suit and hop on the China train? Well, before you go all in on dim sum and dragon ETFs, let's hit pause for a sec and break this down without the hype, politics, or predictions. Let's just talk economics. Here's how it typically goes. First, emerging and more volatile markets drop. We're talking second and third tier markets like China. Then the big boys like the US start to fall. Sure, China might shoot up faster than US blue chips, but here's the kicker: risk-off mode. That's right. Big money loves the risk-off play. Just ask our buddy Warren Buffett, sitting on his cozy $300 billion in low-risk cash and bonds. Right now, with the Fed gearing up to lower rates, the big players have a golden opportunity to bank on one of the most predictable phenomena in finance. When rates go down, the bond market goes up. Liquidity flows into bonds, which, by the way, have way more money in them than the stock market. I mean, the bond market is like a giant sponge. It can soak up trillions without breaking a sweat. Stocks? Not so much. So, if the big boys are in risk-off mode, why would they rush to load up on high-risk Chinese stocks? It's like choosing to go skydiving without a parachute just because someone said, "Hey, the weather looks nice today." No, they've been de-risking for quarters, moving from stocks to cash and bonds. Why would they suddenly flip the script and dive into volatility? Ask yourself this: if institutional investors have been steadily pulling money out of US blue chips like Amazon or Apple for a while, who's left buying those shares? Spoiler, it's mostly retail investors, the little guys. Check the stats, you'll see the same trend. So yeah, before you jump headfirst into Chinese stocks, maybe take a peek at where the smart money is going. Oh, and mark your calendars because my new video will be out in a week. So hit that like button, ring the bell, and get ready for the next video. It's going to be more than just educational. It's going to be a blast. See you in the next episode, and remember, investing is a marathon, not a sprint. Until then, sending you sunny vibes from Greece.